a peak. And here is that evidence. The 80-day cycle VTL, which is that thin blue line that I've just plotted on the chart there, that 80-day VTL was crossed by price, as you can see very clearly and very firmly. It was crossed by price in the first week of April. What does that mean? Okay, when price crosses a cyclic tool, it always has a meaning, and sometimes we're very glib about it. But it's important to understand what that means. What it means is that the 20-week cycle has formed a peak. Now, I should play devil's advocate here and point something out to you. That is that this 80-day cycle was generated from the previous 20-week cycle. Okay, there's that 20-week cycle coming in. The 80-day cycle VTL was generated in the previous 20-week cycle. And if you're an absolute Hurst purist, you might question the validity of it. In fact, Hurst never said that this rendered this particular cross of the VTL invalid. In everything I've ever read that Hurst wrote, which is pretty much everything, he never said that that made it invalid. If it was a downward pointing VTL, it would be different. It would be invalid. But for an upward pointing VTL, he never said it was invalid. He also never said it is still valid. So some people might question that. But if you question the crossing of the 80-day VTL, let's see what else we've got here. You will see that price also, in fact, crossed the 20-week VTL. Now, when price crosses the 20-week VTL, what does that actually mean? When price crosses the 20-week VTL, it tells us that there is evidence of a cyclic nature, that a peak of the 40-day cycle is in place. Okay, that's really important. So what does that actually mean? That means that if there has been a peak of the 40-day cycle, that means that the 40-day cycle is heading downwards now. All right? We have also demonstrated that the 20-week cycle is heading downwards. Okay? The 80-day cycle is heading downwards. All right? We're trading the 40-day cycle. So do we want to be going long? No, we don't, as we established 2 weeks ago. Okay? Because the underlying trend of the cycle is heavily downwards. All right? What does it mean when we have an underlying trend which is heavily downwards? Well, as you might know, I am particularly interested in the shapes that cycles make. Okay? Because the shapes that cycles make in price, once you really understand them, you can trade them really profitably. And so the previous 40-day cycle, what shape did this 40-day cycle make? Well, I simplified the shapes by breaking the shape up into 4 legs. And there are the 4 legs of that 40-day cycle. Okay? Potentially 2 very profitable legs. Potentially, I say, if you could trade them properly. Now, the shape of this cycle here is the shape of a cycle that has a slightly positive underlying trend. Why was that? Well, because the 80-day and the 20-week cycles were both pushing up. Okay, so they were definitely both pushing the cycle upwards, so it should have had a positive underlying trend. Now, what about the cycle that's playing out now? Well, it has a negative underlying trend, as I've already demonstrated. So what kind of a shape do we expect it to make? Well, we expect it to make what we call a bearish shape. That's not very complicated. We expect it to make a bearish shape, and here is what the shape is looking like so far. It moved, the price moved up to a peak formed over there. It then started moving down towards a 20-day trough. We don't know whether that 20-day trough has formed yet or not. We're going to consider that in a moment when we decide whether we want to trade it. But if this is a bearish shaped cycle, we would then expect several things. The first thing is that the peak that occurs in the first half of the cycle is very likely the peak of the full cycle. So in other words, we're not likely to see a higher price in the second half of this 40-day cycle. I'm using terms like likely because in Hurst's cyclic principles, there are no hard and fast rules. It doesn't say you will never see a higher peak in underlying trend conditions that are negative. You will sometimes. The market is full of surprises. Sometimes, we will see a slightly higher peak or an equal peak. But chances are that we will see a lower peak, and then a price will move down to lower than the point at which it started. Here is where it started. It's going to move down to a point lower at which the point at which it started, where it will form its next 40-day cycle trough, which will also be synchronous with the 80-day cycle trough that, of course, is expected at the same time, as you can see from the circle and whiskers pattern at the bottom of the chart there. Okay, so that's what we're expecting. That is what we're expecting from the current 40-day cycle. I'm trading the 40-day cycle. So what would I think of doing? Well, I'm certainly not going to go long. Would I consider trading short? I might consider it, yes. On a personal level, I prefer to only trade short when the underlying trend is very strongly bearish. So in other words, I'm not going to be trading the 40-day cycle into an 80-day cycle trough. I prefer to trade a 40-day cycle only into a 20-week cycle trough at the least. So on a personal level, I wouldn't be trading short. So the simple answer is no, we're not going to trade short yet. We've got to wait. I saw the patient trader online earlier today. It's a fantastic name for a trader. The best and most profitable traders are always the patient traders. So I would not be trading short yet. But if you wanted to explore the options of trading short, then how would you make those decisions based on Hurst's cyclic principles? Okay, well, when you're about to get short on a particular cycle, Hurst had some specific rules about trading short. And basically, those rules prevented you from getting into a market prematurely. Why? Well, again, it boils down to the shapes the cycles make. And let me draw again the possible shape that this cycle is going to make. Okay, I hope you can see that. You'll notice that there are, of course, two peaks to every cycle. Okay, this is the starting trough over here, and this is the ending trough over there, and there are two potential peaks. So when you're trading short, there is the danger that you will trade short at this point here. The market falls down to the intermediate trough, which is, of course, in this case, a trough of the 20-day cycle, bounces out again, and you lose money. Okay, that's the big danger with trading short using Hurst cyclic principles. So what you have to do is you have to wait until the market heads down from the second peak. Okay, it's an absolute rule, but it's not a rule, it's a guideline when using Hurst's trading methodology, that you want to make sure that you're trading short after the second peak. Now, has that second peak occurred yet? Well, there are various ways of answering that question. One is simply to measure it. How long has it been? Okay, it's been 14 days. And I like to put up some counts on my charts so that I can see how many days it has been since the various troughs. Okay, it's been 49 days since the 20-week cycle trough, and it's been 14 days since the 40-day cycle trough. Now, if it's been 14 days, that means the prices are, of course, moving down into the 20-day trough, which we can see very clearly is happening over here. Has it experienced that 20-day cycle trough yet? Well, how do you answer that question? Again, we turn to our FLDs and our VTLs. So let's consider them one at a time. How do we know if a 20-day cycle trough has formed? We know when price crosses up back above the 20-day FLD. Has it done that? No, it hasn't, not yet. Okay, and in fact, of course, when we're considering whether price has crossed an FLD or a VTL, we should always look at median price. That makes it much clearer. Okay, all those candlesticks can get a bit confusing sometimes. There's the median price. Has median price crossed up above the 20-day FLD? No, it hasn't. How else would we know? Well, if there's a 10-day VTL, then when price crosses up above that VTL, we know that the 20-day cycle has experienced a trough. Has price crossed up above that 10-day VTL? You might be tempted to say, yes, it has. There it is. Price crossed up above the 10-day VTL. However, I should point out that that's what is called, in sentient trader terms, an old VTL. It's still presented on the chart so that you can can see the evidence of when price has crossed a VTL. Why is it an old VTL? Well, when price crossed up above that VTL, you go back to the previous trough in price, and you say that is therefore confirmed as a trough of the 20-day cycle. And there it is. It is, of course, the synchronous trough with the 40-day cycle. Okay, so that's all that's telling us. It's not giving us any new information. So the simple answer is that the 20-day cycle trough might have formed. It might have occurred on where was this? On Monday. It might have occurred on Monday, the 20-day cycle trough, in which case price is bouncing out of it now. But we don't have any evidence of it yet. All right, so if we're still considering taking a short trade, and as I pointed out, I'm not really, but if we were, then what would we do? Well, we would want to be sure that in terms of the cycle that we're trading, and let me zoom in so that we can focus just on that cycle. In terms of the cycle that we're trading, and let me remove that count. Okay, and let me draw again. The cycle that we're trading bounced out of the 40-day cycle trough over there, went to a peak, came down to a 20-day cycle trough somewhere over here. Let's just arbitrarily put it there. It's then going to rise up to the next peak, okay, and then we could consider trading short, okay. Now, Hurst recommended that one does two things before entering a short trade. The first thing is that you make sure that you have evidence that the second cycle, the 20-day cycle, in other words, has formed its peak. That's the first thing that you would need to do. How would you find evidence? Well, we would wait for price to fall back down below this 20-day FLD or a 10-day VTL.